It was a tough go for U.S. property insurers in 2017. Along with the spate of hurricanes, widespread wildfires also took an immense toll. The October 2017 wildfires in Northern California were the costliest in terms of insured losses in U.S. history, and 5 of the top 20 most destructive California wildfires ever occurred last year. With us to talk about the wildfire exposure is DeLosa, an AM Best financial analyst, and Bobby Skrabal, an industry analyst. And Bobby, let's start with you. California's governor has called these wildfires the new normal. That being the case, will insurers need to adjust their underwriting, or are they going to have to overhaul it altogether?
2017 was one of the worst years in terms of nat cat losses in recent memory, and the California wildfires definitely added to that insured loss total. There have already been over $9 billion reported from the Northern California wildfires, so the December wildfires should definitely push that total well above the $10 billion mark, making it by far the worst wildfire season in U.S. history. Climate change and migration to more densely populated urban areas leads many to believe that years like last year will be more common going forward. However, insurers will more likely tweak their underwriting rather than there being a complete overhaul. In the near term, expect insurers to raise rates in loss-affected areas, re-examine their terms and conditions for replacement cost values and for living expenses, and to reevaluate their exposures in high wildfire risk areas.
Lewis, what other factors could impact underwriting decisions?
I think catastrophe modeling is going to be key, just with further enhancements and sophistication. As we've seen this year, sustained winds have helped these fires spread and strengthen. So I think the industry needs to have a better understanding of the correlation between these two perils to better estimate losses. And from a rating agency perspective, that could increase required capital, but it is necessary from a risk management framework to develop these tolerances and better have an idea to manage these concentrations. In addition to this modeling, they're also using wildfire risk scoring to identify areas that are particularly exposed to wildfires. However, these models also aren't perfect. A lot of these fires were in areas identified as low to moderate risk. So when you're talking about loss prevention, loss reduction is also key. We're seeing some companies in the industry contract with wildfire defense firms to monitor areas exposed to wildfires, and in the event a fire approaches those risks, they send a team out there and do pre-suppression services, which should help reduce total losses going forward.
Bobby, do you think insurers may pull back from writing coverage in these wildfire zones?
Insurers have already been pulling back writing coverage, but the 2017 wildfire season may accelerate that trend. Recently, California Insurance Commissioner Dave Jones said that increasing prices and non-renewals have reached a critical point. So in 2018, expect regulators to pressure lawmakers to change California law to protect homeowners. Some of the things they've been talking about are protecting or providing premium credits for insureds that meet wildfire risk mitigation criteria, and expect regulators to continue to scrutinize wildfire risk models that insurers use to score these risks. This means the California FAIR Plan, their insurer of last resort, should continue to see an increase in policies. Although some insurers are pulling back, others with larger risk appetites may see this as an opportunity, similar to what's evolved in the Florida property market over the past decade. In the coming year, expect to hear more about affordability and availability of homeowners insurance in California.
Lewis, do you think that insurers had appropriate levels of reinsurance? And going forward, what's going to happen to the reinsurance rates in California?
I think the trend has been for primary insurers to retain more of that risk, and that reflects the solid capitalization of the industry and their ability to more appropriately manage these risks in-house. Obviously, 2017 wasn't just limited to these wildfire events. There were, in North America alone, earthquakes and a very active hurricane season. Nonetheless, we think that their capitalization is appropriate, and that there could be an increase in rates for 2018, but not significantly. While rates are expected to go up, capital does remain abundant, both from traditional reinsurers as well as alternative sources of capital. Combine this with the fact that some reinsurance contracts are also locked in fully or partially for multiple years, and the expectation is that rate increases for 2018 will be moderate to modest and should be manageable for the industry overall.
Thanks, Lewis. Thanks, Bobby.
Thanks, John.
Thank you.
You can find the full report online at ambest.com. And for AM Best TV, I'm John Weber.